You know, sale of goods and purchase of goods, making payment, receiving payment. These are the main activities of any business. Let's take one example. Suppose A is running some business and he sells goods to B. If he sells goods to B, he needs cash. So B has to pay cash to A for the goods purchased. In this situation, A is the seller and B is the purchaser. So B has got three options. Either he can pay the cash immediately to A, or he can give a check to A immediately, or he can transfer the funds electronically from bank to bank in the account of A. But if B doesn't have any money at this moment, he can promise to A that he will pay after 1 month, 2 months or 3 months, whatever it is. If it happens, it means that's not a cash transaction because the payment has been deferred to a future date. For in this situation, A may ask B, okay, you can pay me the money after 3 months, but you give me the promise in writing so that there is no complication or confusion or default in future. And B agrees to this proposal. And B gives the promise in writing to A that I will pay you rupees 1,000 for the goods purchased after 3 months or 2 months. If B gives any promise in writing, that becomes bill of exchange. I'm not going to explain you bill of exchange technically. I will explain all the aspects after the practical questions. I'm just giving you the rough idea so that there is no problem in understanding practical questions of bill of exchange. So this promise in writing can be called bill of exchange, promissory note, or hundi. Basically, hundi is word only used in India or Pakistan or Nepal or Bangladesh. If you use this word of hundi, nobody will understand out of these countries. So anyhow, we will use the word bill of exchange. There are so many features of bill of exchange, technical aspects, legal aspects, but I'm not going to touch all these things. I will explain you at the end of all these practical questions. So let's come back to the situation. A is the seller and B is the purchaser. A sold goods to B on credit basis, means it was credit sales, for rupees 1,000. And B gives promise in writing, means B gives bill to A. A has received promise and B has given promise. And this promise in writing is called bill of exchange. It means A has received the bill and B has given the bill. In short form, bill means bill of exchange. It's a short form of bill of exchange. So technically, A has drawn bill on B and B has accepted bill from A. These are the technical terms you must know about it. So in this situation, A is the drawer and B is the drawee, or B can be called acceptor and A can be called maker of the bill. So in this way, we are going to start practical questions, how they will make the journal entries for bill of exchange. Be careful, we are going to assume that we are going to adopt the accounting cycle. Transactions will be converted into journal entries will be converted into ledger posting will be converted into trial balance, then trial balance will be converted into final accounts. So in this situation, we have got two parties involved, A and B. When they sell the goods, A is the seller and B is the purchaser. Because if it's a credit sale, so A will become creditor and B will become debtor. Because B has given bill to A, so A will become drawer and B will become drawee. or A will become the maker and B will become the acceptor.